So we're going to be looking at some of the common types of mortgages that's available on the UK market. Now, it's obviously nice for you to know all your options before you go out and get yourself a mortgage or contemplate it. So the first type of mortgage that you have is your variable rate mortgage. Now, this also goes by standard variable rate of mortgage, but all this means is that the interest that you would be paying would vary, and it would be dependent on prevailing interest rates. Now, this works great if the market interest rates are at low, but if it's anything like the situation in the UK right now, where the market rates are at a high, it wouldn't work out so favorably because you'd be paying a higher rate. So, again, good example, if the interest rates drop by 6%, you'd be paying 6%, but if it goes up 7%, you'd be paying 7%. Now, the second type of mortgage that you have is called a fixed rate mortgage. And all this means is that if you went out and borrowed some money, the interest rate would be set for an initial period. Now, it usually depends on lenders, but it's usually around 3 to 5 years. So you'd be paying a fixed interest rate. Now, this works great because say in that 3 to 5 years, that period, if the interest rates were to rise, you would be protected because be paying a fixed rate. So you'd be protected against that upward draft. But if the rates were to lower, it wouldn't work out in your favor because you'd be still paying that figure. The third type is my favorite. It's called cap rate mortgages. And as the name suggests, what it does is it protects the borrowers from the rates rising above a particular band or a particular rate. So it caps the extent to which it can go. So a good example would be, let's say you took out a mortgage at 6%. Now, the interest rate's usually based on the lender's standard variable rate mortgage, but with a cap of 7%. So it's based on the lender's SVR, but you put in a cap for 7%. Now, what happens is if the market rates fall to say, let's say it falls to the rates fall by 5%. Right now, if the rates fall by 5%. You, the borrower, would pay at that rate. Now let's look at another scenario. Say if the market rates actually rose up to 8%. So the rates go up to 8%. Now in this instances, you would not be paying the 8%. You would go back to paying the 7% because you've put in a cap for that 7%. So this is one of my favorite types of mortgages because it kind of it protects you against that upward draft, whilst it also gives you a chance to sort of really take advantage of that market rates lowering. Now the fourth type is the discount rate. Now big lending institutions or lenders who give out mortgages, they try to attract borrowers by offering discount rate mortgages. So a good example would be a 6% loan. So if you're taking out at a rate, or if you're taking out a mortgage at 6%, the loan would be discounted say to 5% for the first 3 years. So they give you a bit of discount for a small period of time, and what this kind of does is it kind of attracts people who are looking for a good deal, or some people who want to remortgage the house at a better rate. This kind of is better suited for them.